So open market operations is the first tool of monetary policy, and this is simply government either buying or selling bonds to public. What happens is that government either buys bonds or sells bonds to the public, and this affects the money supply, which then affects the interest rate. So let's look at it from the perspective of an easy money policy first. Right. So an easy money policy is an expansionary monetary policy, right? This means that the government will buy bonds from public. Now let's divide this into two. The government buys bonds back from banks. Let me add commercial banks actually. Commercial banks, and the government buys back bonds from general public. This means that the government will supply cash and it will demand bonds. Now let's assume that the reserve ratio is 10%, that for each deposit the bank needs to keep 10% of it in their tills and they can lend the rest to the public. Now let's say the government buys back bonds worth 100 from the commercial banks. So this means that the supply for money will increase by 100 times the credit multiplier. The credit multiplier is 1 upon leakages. The only leakage over here is the reserve ratio, so 1 upon 0.1. This means that there is a total credit creation of 1000. Right? If we look at it from the general public's point of view, so because of the 10% reserve ratio, they will get 90 to spend. The bank will lend them 90. This means that 90 times the credit multiplier of 10, this makes credit creation of 900. So this is easy money policy, where at the end your money supply increases and it lowers interest rates. On the other hand, if we talk about a tight money policy, let me just write this down: tight money policy. So for a tight money policy, the government sells bonds. Government sells bonds to the public. If the government sells bonds to the public, this means that it will supply bonds and demand cash. And we already know that the cash that lies with the central bank is not to be included in the money supply. So money supply will fall, but it will fall by times the credit multiplier. So the reserve ratio is 10, so the credit multiplier is also 10. So let's say a person buys a bond, and one bond is worth, let's say, price of one bond is 100 rupees. So money supply will fall by minus 100 times a credit multiplier of 10. So money supply falls by 1000. Money supply falls, interest rates rise. So this shows the impact of open market operations in a monetary policy. In the next video, we'll talk about how monetary policy uses reserve ratio for each easy money policy and tight money policy.